A $7.2 billion net loss on paper, but at the exact same time, their core operating engine just blew past $1 billion in quarterly revenue. Welcome to Earnings Unscripted. It's August 11th, 2026, and today we're pulling apart the fourth quarter for Lumentum, ticker LITE. Miro, this feels like the ultimate optical illusion, right? AI data centers are swallowing up every component they can produce, yet the headline prints a loss that looks basically apocalyptic.
Yeah, that headline is an absolute trap for sloppy algorithms. Look, the loss is completely non-cash. What actually happened is their stock price appreciated so much over the past year that they proactively retired a huge chunk of their convertible debt. So the settlement value was wildly higher than the carrying amount, which triggers this massive accounting charge on debt extinguishment.
So basically they were penalized on the income statement just because their stock performed too well over the last year?
Exactly. If you strip out that balance sheet noise, their underlying operations are actually humming. Non-GAAP EPS came in comfortably above the street at $3.23, and they expanded their operating margins up to 36.6%, which is wild because they originally targeted that kind of profitability at a much higher revenue run rate. So this milestone arrived quarters ahead of schedule.
Which is incredible when you think about what they actually do, because, they're essentially building the physical optical plumbing for the internet. The CEO had this wild stat on the call. He said that connecting just 2 modern AI data center sites right now requires double the total global backbone capacity that one major tech giant built over an entire decade.
Right, because the sheer volume of data the hyperscalers need to move is breaking traditional network architectures.
Which perfectly explains the whiplash we saw on the tape today. The stock took a really steep dive right after the closing bell, presumably from people panic reading that massive net loss. But once the earnings call started and management actually walked through the demand, it gapped up hard and just kept climbing through the extended session.
You can't blame retail traders for flinching at that kind of paper hit, though. If we're going to debate post-market panic selling, we obviously aren't offering anyone financial advice here. But the professional money clearly heard what they needed to hear from management.
Oh, absolutely. But what really stood out to me in the filings was this completely unexpected supply agreement they had to scramble for. They're apparently severely constrained on ultra-high-powered lasers right now, and I really want to know what this sudden Indium Phosphide deal means for their actual capacity limits.
Yeah, that AXT deal signals exactly how fast the ground is shifting under them. Lumentum basically realized their internal forecast for ultra-high-powered lasers was entirely too conservative. They need indium phosphide substrates to physically build those units, and the massive AI capital build-out is forcing them to scramble for raw materials in real time just to keep up.
It's kind of wild to picture. You have these multi-billion-dollar hyperscale data centers getting bottlenecked by a single niche material supply contract. But wait, I also read they're literally gutting one of their own internal factories to fix this?
Right, the Greensboro facility. They're pulling out all the legacy gallium arsenide processing systems and fast-tracking entirely new reactor lines strictly for indium phosphide. But here's the catch. That new production ramp won't see its first revenue until early 2028.
So they're reconstructing a massive piece of domestic semiconductor infrastructure inside an old shell just to feed this specific material pipeline. But what exactly hits the market in a few years that justifies tearing down a working factory today?
It's the transition to co-packaged optics, or CPO. When AI compute gets this dense and power-hungry, you can't run standard network optics anymore. You actually have to fuse the optical engine directly onto the substrate right next to the processor just to save power. But since that full rollout takes years, customers are pushing them into NPO right now.
Okay, wait. NPO. I know CPO means putting the laser directly on the chip. So is NPO just a slightly different manufacturing process for the exact same module? Like a cheaper version?
No, that's not quite it. NPO stands for near packaged optics. You aren't putting the laser directly on the interposer yet. You're placing the optical engines on the board just next to the accelerator.
Ah, okay.
hence the near part.
Exactly. It's an intermediate architectural step because full CPO is wildly complex and expensive to deploy. But financially, NPO doesn't just replace older tech. The VP of Product said this step is, quote, significantly increasing the optical TAM at top hyperscalers before we even get to that broader transition.
Expanding your total addressable market through intermediate stopgaps. That's honestly a brilliant way to stack additive revenue while you're still building the final product.
And they're pulling it off with uncharacteristic margins for this specific hardware. A huge piece of that puzzle comes from what they're doing with continuous wave lasers, or CWs.
Right, CW lasers, the traditional tech. Didn't you say those usually have terrible margins compared to their higher-end EML chips?
Historically, yeah. Continuous wave lasers need external modulators, so they've always been lower on the food chain, essentially a highly commoditized technology. But Lumentum figured out how to physically shrink the die size of their CW chips while maintaining incredibly strict quality consistency.
Okay, so a smaller footprint means they get a lot more usable lasers out of a single semiconductor wafer, which drives the unit cost down.
Yes, but the real magic happens downstream for their buyers. When customers try to integrate these bare lasers into their actual network transceivers, Lumentum's components deliver an incredibly high manufacturing yield. You have all these incoming Chinese fabs trying to compete purely on price right now, but their downstream yields are apparently terrible. So Lumentum gets to charge a massive premium for what should be a legacy commodity simply because their upfront precision saves the customer millions in wasted parts.
Oh, so manufacturing yield becomes their strategic moat. They took a low-margin product, refined the physics, and squeezed a high-margin cash cow out of it.
Precisely. But the sheer volume of orders they're taking is terrifying. The CEO openly admitted they're struggling to keep up, and I'll quote him exactly here. We're still shipping behind customer demand on EML. I think what surprised us is high-powered lasers. The demand signal has increased, and we are very much further behind relative to our ability to supply.
That's the part that keeps snagging in my mind, though. If they have to strike these emergency material deals with AXT just to handle today's constraints, you really have to wonder if they can secure enough long-term substrate before that massive co-packaged optics wave actually hits.
It's a massive gamble. Management was actually surprisingly honest about that risk on the call. The CEO openly admitted that, quote, given the rate of change in the demand vector that we are seeing, that may not be true a quarter or two from now.
That's terrifying when you're literally building the backbone of modern AI. But I guess they're not too worried about the immediate horizon considering the forecast they just dropped.
Right. The near term is bulletproof. They guided first quarter revenue to a midpoint of $1.25 billion. The CEO actually said that specific number reaches their target model, quote, more than 1 quarter ahead of schedule.
Which means they're they're defying gravity while simultaneously juggling physical supply shortages.
For now, yeah. The sheer desperation of the buyers is bailing Lumentum out of their own bottlenecks. And they expect non-GAAP operating margins to land around 40% next quarter. That's a ridiculous profitability profile for this stage of a hardware deployment cycle.
It really is. I think the overarching takeaway here is just the physical reality of AI. We talk about cloud computing like it's invisible, but these companies are literally ripping out legacy data center plumbing and rewiring the buildings in real time.
Exactly. The old architecture broke. Well, it's breaking under the weight of AI workloads. Lumentum just happens to own the exact new pipes everyone needs to fix it. We just have to watch closely to make sure they don't run out of raw materials before the cycle peaks.
That's the perfect way to look at it. All right, I think that covers all the important bits for this wild quarter. Thanks for exploring the numbers with me, everyone. We'll catch you on the next earnings call.
Always a pleasure. See you next time.
If you like having these quarters unpacked for you, go ahead and hit subscribe wherever you listen. I also want to remind you that this entire show, our voices included, is fully AI generated. We're an experiment to see if synthetic audio can turn a dense stack of GAAP debt reconciliations into a conversation you actually want to hear the exact same day. Tell us how we're doing or shoot us a ticker request at earningsunscripted.datamadness.ca or check out the X link in the notes.
Catch you all later.